All right, welcome everybody. Today is Wednesday, October 9th, 2024. This is You've Got Options for Income Navigator. Today, we're going to just go through some of the positions that I am holding. I'm going to try to let you hear the voices that are in my head and hopefully get you to understand how I think and what I look for when I consider different adjustments. And, hopefully this makes things a little bit more clear so that I can get you to think the same way or similar. And hopefully this will help you manage your positions as well. So I am sharing my Option at Explorer screen, and this is a position that I made an adjustment for earlier today. This was trade number 2933 for those that want to look at it on Discord in the trade alert section. So this is a trade that I have been in for 57 days. The underlying asset, which is SPX, has moved one standard deviation to the upside from where I took the trade. You can see that the first green dot is where we were. S&P was at around 54.34, and today we are sitting at a new high at around 57.80. So we did move quite a bit. This was a position that started off as you can call this a broken wing put condor, right? This was a um, put debit spread with a put credit spread, and the trade was put on for a very small credit up front. It was about 35 cents. And then um, this was just a couple of days, maybe a week later, I made an adjustment by rolling in the long leg of my put debit spread, collecting a little bit more credit to unlock some of the upside potential. Then few more days, actually maybe a week or two went by. What I did was I rolled my longs down yet again, collected a credit, and I also sold a call credit spread, which introduced upside risk, all in exchange for more potential reward now in this zone between where my put debit is and where my call credit is. So in that scenario, best case is we end up somewhere between 50.80 on the downside and somewhere under 5,900 by expiration, right? I will just keep all of the credits that I am able to collect. And for that to happen, we need to see kind of sideways to maybe slightly higher price action. And the market continues to push higher, which is not a big deal. But at this point now, this is what this trade looks like before making any adjustments today. I am starting to accumulate negative delta, which is not the best as the market continues to push through new highs. It's very hard to find um, it's hard to find willing sellers in the market that doesn't have a lot of headlines that would potentially move the markets. Yes, there are known unknowns that are, I believe, already priced in to a certain degree. Right. We know all the stuff that's going on in the Middle East. We know all that stuff with, the China and the Russia and the election that's coming. And there's a lot of uncertainty, but these are all known unknowns. And I believe that to a certain degree, market is already pricing in that risk. So now there's no um, unknowns that are out there, right? We know that the Fed is going to cut rates in November and in December, probably a quarter point at each of the next two meetings. So all that information is already priced in. Now, if something like a headline that, the Fed does not see inflation risks or recession risks, and the next two rate cuts are off the table, yes, that's going to drive the market, and in my opinion, to the downside. But for right now, there are no headlines that would push the market to the downside. So the market has nowhere to go but up. And when the market drifts higher, if you are a professional money manager and your job is to stay invested, you can't sit in cash. You have to be invested, whether it's riskier stocks or sectors versus some of the more defensive sectors. You have to be invested. And right now, it's hard to get willing sellers to step in and sell the market because if you sell whatever positions you have. You can't sit in cash. You have to put it at someplace else. So there really are no sellers, and the market is just continuing to drift higher. We're, getting pretty close to this round number 6,000. And I'm not going to, make the case that we're going to get there tomorrow. But as the market continues to push higher, I think those that may be missing out, maybe those that are underperforming, are starting to now chase a little bit. We're also headed into the last quarter of this year where, at the end of the year, you have to put up performance. And if you're way behind, you need to figure out ways to step on the pedal a little bit more in order to justify fees you may be collecting if you are a professional. So the market is drifting higher. This position here is not under a ton of pressure, but this call credit spread does have risk to the upside. And if I do nothing to it, one of two things is going to happen. Either we revert back or stay underneath 5,900 or 5,910, and that's great. But if the market continues to push higher and I still do nothing, right, my call credit spread is at 59.10, 59.20, there's a chance that I may take a loss to the upside. The loss isn't going to be devastating, right? My risk to the upside on a 10 lot is to the tune of about $1,000. I don't want to lose $1,000 in a position that is up, about $750. So what I did was earlier today, I just went ahead and I picked up a 59.20, 59.30 call debit spread, which turned, and this is, hopefully we'll be able to see that, this turns the call credit spread into a butterfly. So I'm long the 59.20, short 59.30. So as you can see, right, if you know what a butterfly risk graph looks like, this is a butterfly upside down, right? So this is a short butterfly where I'm long two 59.20s and I'm short 59.10 and 59.30. Those will be the wings. So what happens here is now if the price continues higher, I don't really care too much because what I'm going to lose with 59.10, 59.20, I'm going to make up for it with 59.20, 59.30. But I do need the price to be somewhere either below this butterfly wings, below 59.10, or above 59.30. Right? I don't want this trade to expire with SPX at 59.20. And that's going to be a big problem for me. I think the odds of that happening very, very low. So I fixed my upside problem, which is good. What's the bad? The bad is that I paid a debit, and that debit came out of my potential reward inside of the original zone where I was looking to capture profit. Right? So I gave up some of the profit down here, but I picked up or I removed all of my risk up here. Right? So it's a give and take. And everything we do is a give and take in this business. Right? I gave up some potential reward in the trap, quote unquote, if you will. And instead, I removed upside risk. And now I can just hold it and do nothing. Really, all I have to worry about the downside. Now, the downside is, I don't think that there's a lot of trouble on the downside. Let me just remove this, and I'm going to undo. Right, so this is what my risk graph looks like after today's adjustment. I don't think there's a lot of problems on the downside. The only thing I don't love about this trade is the fact that the T+0 line is really sloping downwards. Also, this position has Reg T margin is over 180,000. This position is a 10 lot and it's in a portfolio margin account. As I say this over and over, PM only looks at up and down 15%. So right now, if we put our price slice at about minus 15%, portfolio margin requirement for this trade is about $23,000. Now, if we start to move down, which is still not a problem because we're ways away from the bonus, if you will, right? This is the real bonus in this trade, somewhere inside of the put debit spread and the put credit spread. The problem for me with that would be if we were to move down to say 5,000, which would be a move to the tune of about minus, 13 or 13.5% from today's price, which is still great, right? We are, you know, in the trap area, which means that if we remain somewhere down here, and as the time runs off the clock, we have a potential of making this bonus, which is great. The problem for me is that if we do move down to about 5,000 on the SPX, if we go and look at a price slice minus 15% from 5,000, my margin requirement for this trade is going to expand. And I'm just looking at the Schwab's platform. And for this trade, right now the margin is $23,645. But if I move my price slice to minus 15%, that margin goes from 23,000 to about 185,000. Right. So margin could expand quite a bit. And I think this is one of those things that kind of give you false sense of security, right? If you think like, oh, if we go down 10%, no big deal. I have a chance to potentially capture the trap profit. What you're not thinking about is how much margin will you need to be able to hold for this trap profit, right? So that's something that we always want to think about, right? Don't only think about the good. The good is, yeah, we could potentially capture this bonus, but are we going to be able to hold this position? Do you have enough capital in your account to be able to hold? Because even though right now portfolio margin requirement is so little relative to Reg T requirement for this trade, if we do move down 10%, PM buying power requirement is going to increase quite a bit. So that's something to consider. For right now, I think the next, this trade still has 37 days, and I don't think that anything else needs to be done. Right? We removed upside risk, gave up some of the downside potential reward, and we can look at what is currently being priced in. Right? This darker shaded area is one standard deviation. This lighter blue area is a two standard deviation zone. So if we move, within a one standard deviation, I don't think that there's going to be a lot of trouble. We can potentially look at what the buying power requirement might look like if we were to move down to say about 55.30. And I'm going to change my price slices 55.30 on the Thinkorswim, and I am seeing my buying power requirement going up to about 36,000 if we were to move down one standard deviation based on today's implied volatility. It's not terrible, but you do need to kind of be aware how much BP you need if you're going to continue to hold as the underlying price continues to move lower. So, oops. This is, we're going to remove that. And then a couple of other positions I have. Let's say this is the another put butterfly. Slightly different, right, to start. We didn't start with a broken wing put condor. We started with a broken wing put butterfly. This trade is 15 days old. We have moved just about a half of one standard deviation to the upside, and implied volatility is up about 30%. I'm not sure how accurate, but yes, implied volatility, it has been rising in the last couple of weeks. Is it 30%? I don't know, but IV is up. And we can see that in this trade. So my thought process here, what do we do here? Do we need to make any adjustments? We don't need to do anything today, right? So if you're not able to attend to this kind of trade, right, you don't have to do anything today. Granted, market's going up. What if the market was going down, right? And we had a market going down, say a couple of days ago. We can go back and see what this trade looked like on October 2nd, for example. And this is probably going to break this. but I'll try to show you guys anyways. Right, on October 2nd, with the market going down, right, this position was at a drawdown, but it was still, fairly decent looking trade with a lot of time to go. You don't need to do something with this trade on a day-to-day basis, right? Market is down, you can hold on to it. The market is up. Clearly, you don't need to do anything. At some point, you will need to figure out how to increase your potential reward to the upside because in this trade, Reg T margin is about 50,000, but we only took in about 1175 in credits, which is, if you try to figure out your return on risk, right, it's not enough. So we need to do something. We need to make some sort of incremental adjustments to improve this trade and potentially get a better yield. So when the market was coming down, yes, sure, this position was showing a slight loss. No big deal. Now the market is back up and this position has improved on its own. Now we know that um, if we do nothing else and the price is somewhere above the structure, the most we can possibly make is the credit that we collect upon entry. So in this case, this was 1175 credit collected. We're about a halfway to max potential profit here without doing anything in the last 2 weeks. Is it time to start to look to make some sort of adjustments? You can say maybe, right? Because the structure, the tent is about 6% out of the money. There's still 51 days to go. I would prefer to act sooner rather than later, but there is such thing as making adjustments too soon, right? So for example, if we put this trade on and there are, let's say, 70 days until expiration, and we start to make adjustments where we're bringing in additional credits, which is essentially we're doing the right thing. What we're not thinking about is how much time there is left and how much directional risk are we taking. So right now, right, my net delta is about 2.5. So I don't have a lot of risk up or down. If the market continues to drift higher, yes, it's going to help this trade a little bit. If the market, starts to roll over and push lower, I don't have a lot of directional risk. So this trade should not take on a ton of heat. If I, let's say, get too aggressive, and in this case, maybe I roll down my longs, I like to start with, what would it look like if I rolled them down 10 points? And then, how much credit am I going to bring in? If that's not enough, then I see, what if I roll it down 20 points? And then, consider my risks, my rewards, how much time is left. So these are some of the ideas. So let's see if I move my 5,500 puts down instead of 10 points, I move them down 50 points right off the bat. Right, that's a very aggressive adjustment, which is great because we're bringing in all this extra credit. Right, if we roll the 5,500 down to, I said 50 points. Let's move that down to 50 points. Down to 5,450. Right, I'm bringing in $6.45 times 10 contracts. So I'm bringing over $6,400 in credit, which would be awesome. But my deltas go from 2.5 to plus 30. So I have a lot more directional risk. And if the market continues to drift higher, yes, that's going to, play into my hand. However, if the market starts to roll over and push lower, right, the risk here is that we're still 51 days away. And if the market goes down just, 3.5% from today, now I'm at a drawdown of about 10,000, right? So I could make 10,000 here. That's my max potential reward. Or if the market goes down 3.5%, now I'm already down 10,000 with a lot of time left on the clock, right? So the time isn't working in my favor. So I still have a lot of time. And if I'm down 10,000 in this trade, now I have to ask myself, how much longer am I going to hold on to this? How much am I willing to lose in this trade to make this 10,000? Like I don't want to be down 60 or $70,000 trying to make $10,000. Risk reward doesn't really make sense in that case. Right? So, and I could potentially put myself in that position only if I make my adjustments too aggressive. So I don't want to make adjustments too aggressive, right? So maybe I'll look at, rolling these 5500s down 10 points. Small adjustment. It's also going to increase my downside risk that I need to address, because if I allocate 50K to this trade, right, and making this adjustment to bringing extra credit is going to put me over that 50,000 Reg T requirement, I will need to do something on the downside to fix that. But let's first look at the credit and what it will do. So if I roll the 5,500 down 10 points, this is just like selling a put credit spread. It will bring in about $1,300 in credit on a 10 lot. Right. It's also going to increase my downside risk by about 8,600 or $8,700. It'll also change my directional risk from about 2.5 to about 8.5. Right. So I have a little bit more downside risk because my delta it has increased. And as I said, the buying power requirement is what I need to keep in check. So I can't just sell a put credit spread, increase my downside risk, and do nothing about it. So my go-to adjustment is also to roll up the downside long puts, maybe 10 points. All right, so I want to keep my Reg T risk under 50,000 throughout the life of this trade. So by rolling my downside longs up 10 points and rolling my upper longs down 10 points, right? I'm pinching in the wings. I'm rolling the wings down on the upside and up on the downside. I will have collected 75 or 80 cents on 10 contracts. It's about $800, right? My Reg T risk is in check. My upside potential profit has increased by about $800. So now instead of 1175, I'll have about 1975 in credit. So that's my max potential reward. It's still not enough, right? Because if I allocate 50,000 to it, like I need to get to at least maybe 2,500 to $3,000 in this trade to make it worthwhile. And I still have 51 days to potentially make these incremental small adjustments that will just push me a little bit closer towards my goal. What's my goal? My goal is to make about $2,500 on the risk that's in this trade right now. Right. So we're not going to get there tomorrow. The only way to get there tomorrow is if we make an extremely aggressive adjustment and the market is going to move in the way that we need it to move. But if we're wrong and we make an aggressive adjustment and the market moves against us, this will actually set us back a little bit, right? Doesn't mean that, it's lights out, but we'll be behind and we'll need to potentially make more adjustments to fix our position. Again, my goal is to keep my T plus zero line as flat as I possibly can. And you can see that on the way up, if I made this adjustment today, right, now my delta is 5.8, right? So it goes up. I get a little bit more directional risk. More directional risk is not great, right? We don't want to have directional risk, but if we are taking on extra directional risk, we're also taking in $800 of credit. So it's a give and take, as I always say, right? So, and then you can see that on the way up, I'm going to start to lose my directional risk. I'm going to lose my delta. So as we move higher, I may need to roll my longs down again. And then if that's going to put me over that $50,000 Reg T requirement, may have to roll my downside longs up, just like, I showed right here. Right. Rolling rolling the wings up on the downside and down on the upside will bring in additional credit, and that is going to fix my directional risk. If I lose all of my positive delta on the way up, By rolling in the wings, I'm going to increase my delta or bring it back to positive, collect a little bit more credit. And that's all going to be at the expense of giving up some of the potential reward. As you can see that the blue line here, this is the expiration risk graph before I make any adjustments. The green line, if I make an adjustment and I'll bring in that 80-cent credit without taking on additional downside risk, well, what's it costing me? It's costing me potential reward inside the tent. As you can see, my tent now is smaller, which I don't really care about because I'm not playing for the tent. I'm not playing for the tent. I don't want the price come anywhere near the tent. All I want to do is manage my T plus zero line. I want to keep my deltas as flat as I possibly can, keep my downside risk in check. I don't want it to exceed 50K. And I want to potentially somehow, somewhere squeeze out at least, 5%, maybe 7% on this trade, and hopefully get out of this trade before, I like to think 18 days until expiration would be a good time to part with this trade, regardless of um, what the outcome is, especially if we are somewhere very close to the structure, because you can see with 18 days to go, if we're somewhere here, right, around 5,500, 5,600, it's not a big deal, right? But if we're somewhere near this tent, you can see that my T plus zero is really starting to dive on the way down. And as days go, if you just look at the T plus zero line, and I'm going to move the time up one day at a time. So this is with 17 days to go. As you can see, as I move the clock forward, right, my T plus zero is really going to point downwards here, and that's going to increase my potential volatility in my P&L in this trade. So if I'm somewhere inside the tent and I'm starting to run short on the time, I'd rather get out, because a lot of times, people get tricked into thinking, oh, if I just hold it for another day or two, maybe another week, and see how much I can get out of this tent profit potential. It could work once, it could work twice, but if you do get some sort of a 3% move the following day, and now you go from a really nice, profitable trade to maybe a break even trade, that's going to affect you psychologically, and nothing good happens after that. All right. So, um, for right now, what am I thinking about this? I probably am not going to do anything until sometime next week, right? It's 15 days in. I think it's kind of early. I would like to hold these trades for about 3 weeks, maybe 4 weeks before considering doing any kind of adjustments. That's why when you start these trades, if you start at about maybe 65 days, 70 days, you can let first 30 days go by, right? And from a 65 down to about 35 days, maybe it's cutting a little too close, from 70 days down to 40 days until expiration before making any kind of adjustments. That's kind of like the zone or the time frame where I want to be. Start the trade with about 70 days and um, give the first 30 days, let the market do what it's going to do. If nothing happens and we took in a small credit, we're probably going to be maxing out that small credit in the first 30 days. And now, after the first 3 or 4 weeks have gone by, now we can start to look at making some kind of adjustments to drive in extra credit while keeping our directional risks in check. Hopefully that makes sense. Yes, this would also apply to a trade 2993. I think is 2993. Right, it's an ES trade. And while we're on it, we can definitely look at that trade 2993. Hang on, let me pull that up. 2993 is right here. Now, this is a little bit different, I guess, right? Because and major difference here is that number one, we're using ES options. And also we are taking advantage of um, span margin, right? Span doesn't look up and down 15%. If it did, our margin requirement for this trade would be a lot higher. I think, and it really sucks that, we can't look on Tasty Trade, for example, to understand how much buying power this trade takes up, unless we do a closing order and then look at how much buying power that's going to free up. Too many clicks, too many. I mean, sure, we want to look at it at least, every couple of days just to understand if our margin is expanding or contracting, or buying power requirement is expanding or contracting. But, if I wanted to look at it intraday real quick, it just takes way too much attention from other things, and I don't really enjoy it. But in this trade, let's just talk about when we took this trade, what are we looking at here, right? This is a similar structure. It's a broken wing put butterfly. This is a 10 lot. The reason why it had to be a 10 lot, because anything less than a 10 lot, in my opinion, you just can't justify the commissions and fees in this trade. Just not worth it. Like you're collecting $1,000 and paying maybe $300 in fees. It's crazy. I mean, puts me and Tasty as partners in this trade, except I'm taking all the risk, right? And a 10 lot, um, this took about $7,000 of buying power. We have a potential reward of about 1375. So I would be a lot less active with this trade, assuming that the buying power requirement, right, span margin doesn't increase a whole lot. If I can make 1375 on, even call it a $10,000 span margin in this trade over, maybe 60 days, that's like what, 5% a month, right? Return on risk being, or return on span margin. It's not terrible. So we don't have the need to increase our potential reward to the upside. I think the reward that is already baked in is pretty healthy relative to how much margin you had to put up to put this trade on. Does that make sense? Let me go back to the SPX. I think we covered. Well, there's just one more SPX position that I wanted to take a look at, and that is a trade that we put on 5 days ago. This was a little bit more neutral, and more neutral meaning when we were here, this was October 4th, last week, Friday. See, I can move this. Clearly, we don't know if the market's going higher. We don't know if the market's going lower. This is what everything looked like, right? So we have MACD's kind of just, flattening out. And actually, I think that MACD was crossed bearish, even though the market was up over one standard deviation on that day. Um, RSI was at 62.35. So there's really no clear indication. Yes, the market is rising. But I did not want to start this trade with a whole lot of directional exposure right away. So what I ended up doing is I set up this trade, and you can't set up your trades any way you like. You don't have to do what I do. You don't have to agree with what I'm doing, right? We can talk about it. We can bounce different ideas, and this is the purpose of what we are doing here. But in my opinion, there was no need to get aggressively bullish, right? So I chose to set up this trade in a way that I had no upside risk. I'll worry about that later. And my net delta to start was relatively flat. So now 5 days have gone by. The market has moved 0.64 standard deviations to the upside. So I can't say that we're moving with, the speed that was not being already priced in at the time, right? We had a down day, we had a couple of up days. Now we're taking out previous highs. So yes, maybe there's more upside to follow through, but you can see that right now, what's my problem here? My problem is that if we continue to move higher, I don't have the delta I need or I would want to have, right? I have a negative delta, which means in theory, I should be losing some money due to my delta component. I do have positive theta. So, if we move, what's a 1 day ATR on SPX right now? Maybe I can look that up. Maybe a 1 day SPX ATR right now is at um, bear with me. So ATR right now, 14 ATR is at 59 on SPX. Okay. What does that mean? That if we move 60 points to the upside in 1 day, I will probably lose about $60 due to my delta component, but I'll make up about $40 in theta. And if we move higher and volatility falls 1 point, it's like VIX going from 21 to 20. In theory, again, this is not what's going to happen, but we can kind of understand what we should expect to happen. I'll lose, say, if we move one ATR up and volatility falls 1% or 1 point, I will lose $60 to my delta. I will gain $40 due to my theta, and I will gain about $280 due to my negative vega. Is that what's going to happen? Probably not. But the point is that if we continue to move higher, I don't think that it's as scary. So I can actually hold on to this for maybe another couple of days, maybe a week, maybe more, and then figure out what do I need to do to drive in some additional credit to increase my potential reward to the upside. I think a bigger concern for me in this situation is that if we continue to move higher, even though I don't have any upside risk, the long puts of my put debit spreads are getting farther and farther out of the money, which means that rolling these long puts down won't bring in as much credit as they would if I was to make an adjustment early on. Right. So again, let's weigh in the good and the bad, right? If I make an adjustment early, the good is that I will collect more credit. The bad is that I will take on the directional risk I may not want to have, because if the market sells off and there's a lot of time on the clock, this will make this position very difficult to maneuver. There's going to need to be adjustments on the downside, and right. So we need to find like this perfect balance. I do think that a reasonable adjustment for something like this is, let's give this trade maybe 2 weeks, at least 2 weeks, right? So this is a no touch for the first 2 weeks. If we sell off and we pull towards the structure or the tent, this trade is probably going to be at a drawdown, but it's not going to be massive because we don't have a lot of delta. Even if volatility is going to increase, which it probably will, right? We do have negative vega, but it's not going to explode on us because we do have defined risk in this trade. So we are able to hold for at least 2 weeks just to see what happens, right? It's a no touch for the first 2 weeks, regardless of what happens. If the price runs away, say we move 5% higher, these options are going to be very far out of the money to do something significant. So now we need to figure out, maybe we're selling put credit spreads closer at the money, introducing like this little um, sea of death. And let me show you what that looks like. Also, not my favorite, but I guess we would have to do whatever we can, right? If we can't roll the 55.75s, which is the long leg of my put debit spread, and we are forced to go something closer, like 56.50 maybe, right? We'll sell 5 of those and maybe we'll go down, 30 points, right? So that will drive in the credit that we're looking for, but it will give us this area where we could, if we expire this trade and we end up somewhere between, right, 55.65 and maybe 56.45, that's not going to be fun, right? So we're taking on the risk of ending up somewhere inside of this sea of death in exchange for that premium. But that's what we would have to do in order to collect any significant premium. And that would only happen if the price is so far away from the tent where we have to move closer to at the money, introducing this sea of death risk. Right. So I think the rule for me would be first 2 weeks, no touch. We started this trade with about 77 DTE. If 2 weeks goes by, let's see what that looks like at about, maybe another 9 days. So this is now T plus 14 from where we start, right? You can see that if we're somewhere within a 1 standard deviation, in theory, this should be a profitable trade. We don't really see that happen too often, but technically, right, if we hold it for 30 days, so at T plus 25, there should be something like a T plus 0 going above the expiration line, right? And building like this hump, if you will. We don't really see that too often because we're seeing volatility closer at the money being sold. And when volatility closer at the money being sold, that kind of creates a net positive volatility change if you compare IV for options closer at the money versus those that are farther out of the money. So what would happen is, if that is what is going to happen, if volatility close at the money is going to fall faster than volatility of further out of the money options, this will create a net positive IV change effect. And you can see what T plus 0 line is going to do if I just take volatility up a couple of points. Right? So we can pull back, and if volatility closer at the money is falling faster than volatility for options that are farther out of the money, instead of building a hump, T plus 0 line actually dips below our expiration line. And we do see that quite often, and we are seeing that same exact thing right now, where we have even 112s, 111 positions where we are in the tail. And as the time goes, T plus 0 line, instead of going above the expiration line and building the hump, it's actually getting pushed down because of the net volatility change in options that are part of that trade. So with this trade, I would probably just hold it for a couple of weeks just to see what happens. And then, right, as the times, if we're running away and we need to jump in and do something before the first 2-3 weeks rolls off the clock, we will. But at least for the first 2-3 weeks, it's a no touch. If we had collected a little bit more credit up front, right, in this trade, this is a 10 lot. I collected $100 credit for this trade. No big deal. If we had collected more credit, it would be probably better. We would have a little bit more positive delta to start, but we would be a little bit more profitable in this trade. We're not. Still no big deal. My first go-to adjustment is going to be to consider rolling my upper longs down, maybe 10, 20 points, depending on where we are. Once I bring in this credit, I also have to keep an eye on my Reg T margin. Again, Whatever your allocation to this trade is, you have to keep within those guidelines. For me, I don't want to push more than 50,000 Reg T into this trade. I want to put these trades on, maybe every week, maybe every 2 weeks, and just continue to run multiple trades at the same time. So if I'm going to allocate $50,000, doesn't mean that if I do this in a portfolio margin account, doesn't mean that I have to put up $50,000. But in my mind, my planned risk in this trade is 50K. So whatever adjustments I'm going to make, I don't want my break T risk to go far more than 50,000, or, call it 50,000 max. So if I'm making this adjustment, I have to see what is this going to do to my Reg T risk. Am I exceeding 50,000? If I was to roll my upper longs down 20 points today, my Reg T risk would go up to about 46,400. I probably wouldn't drag my downside longs up to reduce my Reg T margin, because I'm within that $50,000 that I had already allocated to this trade. Right? So I would bring in additional credit. My credit will be at about $3,700. My risk is somewhere around 46,000. And if I do nothing else and I expire this trade somewhere in the tail, I'll make 3,640, call it $47,000 of risk. Right? It's about 7.5%. If it takes 77 days to do it, right? 7.5% over 77 days times 365 days. This is an annualized return on risk rated for about 35%. Now, that's not to say, and I know a lot of people think that, oh, 35%, that's great. I'm just going to put my whole account into this. That's the wrong way to think about, generating returns. But you want your risk to yield a reasonable enough return for you. Right. And with these kind of trades, because they are defined risk and how much buying power could potentially expand to, you don't necessarily need to keep 50% buying power available. Right. Sure, you want to keep some dry powder, but you don't need to stay at 40% BP usage at all times and leave a bunch of, because BP here could only expand to what your Reg T margin is. It shouldn't go beyond that, right? You can't lose more than the width of the strikes in your put credit spread minus whatever credits you collected. So buying power here is in check. You know how much buying power could potentially increase to. So you can get a little bit more aggressive as far as allocations go. You can probably go up to, 75%. Again, and I'm not saying, like, if you have never traded these before, you definitely don't want to go to 75% BP usage. Do a one lot, right? Do two lots for like 6 months. Don't have four positions going at the same time. If you can manage one position for 6 months successfully, yes, it's going to be slow. It's not going to generate the kind of returns you're looking for, maybe. But if you can, manage one position for 6 months successfully, and then go to two positions and roll from one to the next, maybe they're 30 days apart or whatever, right? At some point, you're going to get to that, 75% buying power usage allocations. And, then you'll have a well-oiled machine running and, getting you the kind of returns that you're looking for. So the point is that, you can go a little bit heavier on BP usage in these trades, but you do need to know or understand how these trades work, and how to make adjustments, what kind of adjustments to consider. I don't really like to, I can give you a list of adjustments that we can do here. And for me to tell you which is best would be, I don't know if it's irresponsible. I think it's just flat out wrong, because to me, rolling down long puts, right, selling my upper longs and buying them lower, is this a good adjustment? Maybe it is for me because I'm near term bullish. If you're sitting there in a bunker And you still need to make some sort of an adjustment here. Maybe you don't need to do this adjustment. Maybe instead, if you're still trying to, right, our goals are the same. We're trying to increase our potential reward somewhere outside of the structure. Maybe for you, the adjustment, if you're bearish, would be to sell a 15 delta call credit spread, right? Maybe you'll sell 10 of the 6120s and then you'll buy 10 of the 6130s. It still accomplishes the same thing, right? We're bringing in a credit, except I'm increasing my net delta. And you, if you're bearish by selling a call credit spread, you're not increasing your delta. You are actually going more negative delta. But we're both accomplishing the same thing. We're looking for more credit inside of, right, some kind of a price range. The difference is I sold a put credit spread and you sold a call credit spread. Right. So for me to say this is the way to do it, this is the only right way to do it is wrong. There are many ways we can do these kind of adjustments. And my goal is to, show you how I think about these trades when I make these adjustments. And if you disagree, we can definitely talk about it, right? Put your best ideas forward. We can go back and forth respectfully, right? Come to some sort of conclusion. And in that discussion, hopefully others that will be a part of will all get to learn something new, right? We're not going to call each other names. We're not going to, go at it. But if you have different ideas, put it forward. Explain why you think what you're thinking. There's no wrong or right. Maybe you are right. Maybe your idea is better, and I will consider making that adjustment for myself rather than, but I think that if we don't put these ideas out there, then nobody really learns anything new, and it just becomes, um, you know, follow the leader. Everybody do adjustments like I do, and hopefully I'm right and everybody makes money. And if I'm wrong, everybody's screwed. That's the wrong way to go about this business. So that's for these SPX defined risk butterflies. They're very flexible. They are first and foremost, um, they are very forgiving at first when you have a lot of time until expiration. You can see if you can keep your T plus zero relatively flat, these are going to, if the market goes up or down a little bit, you shouldn't expect a whole lot of changes until we start to, run the time off the clock. These trades do not do really well if the market starts to move in excess of 3 standard deviations on a day-to-day basis, right? If we move 4% to the downside tomorrow, yeah, we're probably not going to take as much heat as if this trade was undefined risk. But major swings, especially down, where all of your risk is on one side, is not going to be great for this trade. So your outlook has to be at least stable. Like you don't expect the market to crash. These are going to do well, especially if you can deploy incremental adjustments to increase your potential rewards while managing your downside risk if you are only trading these with risk on one side. I think everybody should consider doing it. 112s, 113s, 345s, those are all great. But if you are looking for an alternative, I think these are great. And I'm here to show you how I trade these. I do trades as such in a much bigger size in a portfolio margin account, taking advantage of the leverage that portfolio margin offers. But as I always say, with great leverage comes great responsibility. Like you have to understand how things could change, where things change, where your risks are, and Option Explorer definitely helps me visualize that. So hopefully this was something that you guys can use in your trading. I definitely appreciate your time. Thanks for coming out and taking the time to tune in today. We're going to come back on Friday. If nothing changes, I'm going to do this on Friday, except we're going to go through some positions in the ES and look at span margin positions. I have a couple of pretty cool ideas I want to share with you guys. So that's going to be on Friday at about 1 o'clock. I'm just going to check to see if there were any other questions, and I'm going to let you guys go to enjoy the rest of your day. Let's see, on broken wing butterflies, where you have collected a small credit, you allowed trade to breathe about half before making adjustment. Is this a good practice? With I think it's a good question, and you do need to understand that these shorter DTE trades, they are a lot more sensitive to price change, which is bad, right? Like you don't want P&L volatility at all. Like if you can have a trade that doesn't really react as far as P&L goes to price changes on a day-to-day basis, right? You need to be way, way out in time, 72 days, 90 days. The bad for the trades that are 72, 80, 90 days away, the rate of decay is so slow that you will have to be in this trade for a longer period of time. While doing the 14 and 21 DTE trades, you get paid a lot faster. You can turn your BP over many more times than if you were to do a trade 90 DTE. That's good, right? You can potentially generate more profits, more returns on that same buying power. But the flip side of that coin is that now you have a little bit more, or maybe not a little bit, depending, how you structure your trade, but you definitely are a lot more sensitive to price change, right? This is a function of short gamma. Um, I think what you're asking is giving the trade half of its DTE to work itself out. Um, you know what? Maybe. Let's see, and again, this is going to be, just based on what the uh, this software assumes, no big swings in implied volatility. And implied volatility shouldn't really play a big role, but it does. Um, let's see what this trade would look like if I was to set something up with 21 DTE. So this is October 30th, right? And let's see, if we set up this trade, you collected a small credit. So let's see, maybe we'll do something like, the way I like to structure these trades, I want to put the structure, right? The price right now, the S&P is at 5778. So I don't want to, I'm going to put this on, let's say if I put it at, 5400 center strike and collect a small credit, there's really not a whole lot I can do to potentially increase my um, profit outside of the structure, because the whole thing is so far out of the money. And as the time goes and the value of these options decreasing, right, I can't roll and collect any significant credit. So there is such thing as placing this trade too far out of the money, right? We talked about this last time. Putting a trade too far out of the money gives you more safety. But the flip side of that, right? Safety is good, but the flip side is that you can't really make any more incremental adjustments to collect any significant credits to improve your positions. So you kind of just have to put it on and just wait it out. Where is that perfect balance between too far and not too far? I don't know. I think that using maybe a 30 delta for your long leg of your put debit spread is probably a good starting point. Again, I like to use, Option Explorer to model these trades to see what they look like, and then let this risk graph talk to me about, do I like it or do I not like it? Again, putting on this trade with 21 DTE, your price outlook for the next 21 days have to be stable. If you have some major Fed announcement, if you have some sort of something that any kind of known unknown could put kibosh on this trade really, really quick. So if I put my long leg at about 30 delta, so that's 56.80, maybe I'll go down 50 points. Right, 56.30. I'll sell two. And then I'll go down. Oh, let's see, 80, 70, 60. Let's try that. All right, so here this trade is done for either a small credit or a small debit, maybe for even money. Is this a bad trade? Right, my Reg T margin for this trade is $2,000. Right, the difference between these two spreads, the put debit spread and the put credit spread, is 20 points or $2,000 per one lot. I take no initial credit. I have 21 days to figure it out. What am I going to figure out? What I want to figure out is how to, if the price remains above the structure, eventually my put debit spread and my put credit spread are going to expire worthless, and all I get to keep is what I had collected up front. If I collected nothing, I took this risk for nothing. So this trade does need something. However, there may be a chance that, maybe 14 days later, the price slowly creeps towards the structure and then will be right. So the value of the put debit spread may be increasing while the value of the put credit spread is increasing, but not as fast because the move is slow to the downside. So you have the put debit spread, which is still out of the money, is starting to accumulate some of the extrinsic value. And maybe you could make $300 in 14 days. Now, $300 on $2,000 of risk in 2 weeks, that's a pretty good rate of return, right? But the risk is with these trades, if in 2 weeks we saw a move of 4% to the downside, this trade is going to be in trouble. Whereas if we look at a 4% down move, right? So let's look at this again. So 14 days later, if the move is to the downside to the tune of about 4%, right? This trade is going to be in trouble. Is this trade going to be the max loss? No, because there's still 7 days, but it's going to be pretty hard to recover without making some pretty aggressive adjustments where you may have to take on additional risk. Now let's compare that to a trade like this that we took with 70 with 77 days until expiration, right? Inside of the next 2 weeks, if we see a move down to the tune of about 4%, this trade is not in trouble. We're just barely getting into this trap. Yes, volatility might rise and it's going to push T plus zero down, but it's not going to be anywhere near a disaster. And we still have 58 days, which means that any adjustments that we're going to make, they're just not going to cost as much as they will cost if we only had 7 days until expiration. Right. So the takeaway here is that when you trade with less time until expiration, the good part is that you're going to turn over that buying power more, right? The velocity. You'll turn that buying power over more times and potentially generate more profits than if you were to do a trade 90 days until expiration. But the trade that only has 21 DTE is a lot less forgiving if you do see a outsize move in the first, 2 weeks, and you only have, 3 or 4 weeks until expiration. So you kind of have to find your balance, and you also have to be a lot more uh, alert with a trade that has only 21 days until expiration. You can't really, I mean, you shouldn't. You can do whatever you want, but in my opinion, you shouldn't put a trade on and then only come back with 3 days until expiration to see if, that check showed up. You have to look at it at least once a day at a minimum and potentially stay on guard to make whatever adjustments you may need to make to defend your position if it gets in trouble early on. because the longer you take to make any sort of adjustments to fix your position, the more it's going to cost. And if you're going to do adjustments where those adjustments are debit adjustments, the longer you wait, the more of a debit you will have to pay, which means you will have to put up more risk into this trade. And, it's very easy to dig yourself into a pretty, bad situation. All right. With that said, I'm going to say again, thanks guys for coming out and tuning in. Hope you learned something new today. If you have any questions, you can always ask questions in Discord. We'll be back on Friday. We'll look at some ES positions. Until then, trade them well, and I'll talk to you guys next time.